we've talked about this. So I first talk about the process a little bit and what we do maybe differently than we've done at previous firms I've worked with. And so I've got two phenomenal analysts on the team. They're in the audience now, and I was remiss in not mentioning them earlier. But they've been colleagues since we started the firm 6 years ago, and they were former students at Columbia, so I've known them quite a long time. We definitely do our research process and our search process differently than I did historically. So we cover the market, global small caps, probably somewhere upwards of 20,000 possible securities to invest in. We do have a pretty diversified portfolio, so we might have 80 longs at any point in time, but that's pretty extreme numbers for three people to kind of figure out where you're going to look, right? And I had a former boss ask me once, like, how did you come with the portfolio? You know, he said, did you miss anything? And I said, of course we missed something. Like, I mean, but how do you want me to search? What's a better way to search? Do we start with the largest market cap? Do we start A to Z or the lowest number in Korea or Hong Kong or Japan or something? And how should we search? And so what we built was our own screens to basically narrow down the pond we want to fish in. We want to look for characteristics of things that work. We are very heavy data users, and it's all about, in my mind, at the end of the day, we're in a risk-adjusted return on capital business for our investors. But at the end of the day, the most important thing any of us have in the room probably is time. And the analysts are really in a return on time business. We've got, as Julian said, there's tons of things to look at in the space. We're not bored. The analysts never come to me like twiddling their thumbs saying, I've got nothing to do. There's always more to do. So you got to figure out the way to be more efficient about it. So, you know, we use Bloomberg intensively. We built a lot of screens in Bloomberg. We've been told we're one of the biggest users of Bloomberg in terms of data. They did a build out 6 years ago. It coincided with us launching the firm, and we did a lot of checking their work and catching bugs, and it's enabled us to have access to a lot more data we wouldn't have had otherwise. So that's our start of our process, right? It's figuring out how to narrow the universe down from 20,000 to 500 or so that make our watch list. And then it's deep fundamental research. But that gets us to the point of we don't spend a lot of time wasting 15 minutes an hour, a day, or a week on an idea that's not likely ever to end up in a portfolio. And at the same time, an analyst is looking at an idea, we're also doing independent risk analysis of that idea to see how it fits in the portfolio. So from that perspective, that's a little bit how we're different in terms of the research process. In terms of the best ideas, we're going to talk about that. I mean, everyone wants to talk about best ideas, and I think, unfortunately, and Dave and I talked about this before, I think we're much better off talking about the big opportunity in our space. Because I think that the idea will sound interesting, maybe, maybe not. It may work, it may not, right? But the key right now, because the opportunity set is so amazing, we think, in international small value, is to focus on the big opportunity. So don't focus on the trees, focus on the whole forest today. Normally I'd want to talk about stocks, but not today. You know, others have said it maybe implicitly or not, but our research shows that if we take the factors, international small and value combined, they're the cheapest they've been in at least 55 years. Probably goes back to the Depression, but the data is a little sketchy before then, so we use our charts of like 55 years. Stocks are, you know, these stocks are so out of favor. They've been out of favor for a long time. It's gotten worse, so you ask about a mistake. We've been early on this, but we think they're only getting cheaper and cheaper. International small value had its last big run around the blow up of the dot-com bubble. We think there are a lot of parallels between the current market and the dot-com bubble and it burst. We think valuations across the board in U.S. large cap growth are more extreme than they've ever been in the past, higher than 2000, higher than 1929. We think the risk is extreme. I'm not making a comment about what to do with your Mag 7 or now SpaceX or anything else, but we think there's a great opportunity in international small value. They had a phenomenal run, 2000, 2003. NASDAQ goes down 75%. Jean-Marie killed it, international small value. The big difference today, though, I would say is international stocks are much, much, much cheaper today than they were then. International stocks have to more than double to get back to the lows of the 2000 timeframe. So it's not they're cheap, they're a little bit cheaper, they're a lot cheaper than they were before. And the combination, we strongly believe these factors do mean revert. The question that the big unknown people ask is, when's it going to happen? I think anybody tells you they know, they're lying to you. Nobody knows. But I do believe it will mean revert. And even if it takes an extremely long time, 2 or 3 times longer than it's ever taken in the past, the risk-adjusted returns for international small value look pretty impressive today.